Hey there, everybody. It's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage. Welcome to another edition of Java with Jared. Happy Friday once again. Hope everybody is doing fantastic. Well, interest rates are not doing fantastic. Once again, we are under some upward pressure. And what happened this week is pretty important. In fact, we haven't seen these rates since about 2011. Freddie Mac announced that the average mortgage this week broke above a level that we haven't seen since May 19th of 2011. So it's been some time since we reached levels at this, higher rates. And it looks like there's a possibility that 5% interest rates might be somewhere in our not too distant future. It's very possible, because what happened this week is the 10-year Treasury yield. Now, average mortgage rates, a 30-year fixed rate, follows most closest to the 10-year Treasury yield. So as the yield goes up, so do interest rates. And that broke above a very important technical level. It was 3.04%. Now, a couple weeks ago, we hit that level, and then we rallied, so that made rates improve a little bit. But a lot of times when those levels are tested for the first time, they don't break it, and then when they get tested again, they can break it, and that's what happened. And so the next major level of support is about 3.39%, and so that means that we could see interest rates, if now that we've broken above that 3.04 on the 10-year Treasury, if we hit that 3.9 or 3.39 yield, that might equate to interest rates being another about 0.3% higher, which would bring it at or above that 5% interest rate. Now, I'm not thinking that we'll be there for a long period of time and it's going to go a lot higher. Let me show you this graph here, because eventually we will hit a recession and interest rates will improve. One of the reasons that we're seeing interest rates increase, or a few reasons, is one, the economy is doing pretty good. There's more inflation concerns, and the Federal Reserve is not buying as many mortgage-backed securities. They're doing the quantitative tightening, in essence, the opposite of the quantitative easing, where they were buying lots of mortgage-backed securities. They're curtailing that, and April was another month where they curtailed the purchases, and so that's having an effect on interest rates. And until the economy kind of reverses course, we'll probably not see a lot of relief in interest rates. But let's take a look at this graph right here. So this is the average 30-year fixed rate delivery price according to Freddie Mac, and you can see we're right here. We were very close just in 2017 and back in 2013, but we've kind of breached these levels, and so it's back at 2011 levels. But you can see here, every time that there is a recession, and these gray boxes here are recessions, we do see interest rates improve. So we go into a recession, rates improve, recession, rates improve, recession, rates improve. And way back here, again, rates were at a real high level, but we hit a recession and rates improve. So hopefully we will see some relief, and I believe that interest rate, or that a recession probably is sooner rather than later. Again, going back to this chart, you can see that the last recession here, we got out of it in 2019. So it's been pretty long time here. We did have a nice stretch back here, but usually recessions happen every 5 to 7 years. Sometimes there can be almost these 10-year spans. So we're getting closer to it probably than not. It's probably not going to be a deep recession, but I think it's pretty realistic that sometime maybe this year we'll see interest rates get to that 5% level. There's going to be good days and bad days, but we're urging our clients, when they get under contract, to lock just as soon as possible. The great news is wages, especially here in Denver, are keeping up with these slightly higher increases in rates. We don't need as much of a wage increase to counteract the increase in interest rates. So it's still very, affordable for a lot of people. Then with the appreciation, though, that it is putting some people out of the market with higher rates and higher appreciation. We'll keep you informed as to what's going on. We might see a little bit of a relief rally here in the next couple of weeks, but we breached these important levels here, and so the next level is about another 0.3% higher. So it looks like that could happen here within the next 6 months or so. We'll keep you informed. If you have any questions, give us a call. If there's anybody that you're working with this weekend with that needs some help, we'll be here to help. Thanks for joining me with Java with Jared, and happy Friday. Bye-bye.